right now in America, you have to earn, I think it's about $50,000 more a year just to afford buying a house compared to renting that exact same house. Like the fundamental math of the American dream has just completely broken down.
Yeah, it really is a profound structural shift. I mean, for decades, the financial playbook was incredibly predictable, right? You
Yeah.
rent an apartment to save money, and then eventually you buy a house to build wealth.
Right.
But today, that equation is entirely inverted. It's upside down.
It really is. Well, welcome to today's deep dive. We're so glad you could join us for this one because our mission today is to unpack the rapidly shifting landscape of the U.S. rental market.
Which is shifting fast.
Fast and hard. What we are really looking at here is a system that has effectively split into two entirely different realities, just depending on where you sit on the income ladder.
Exactly. And to map out this new terrain, we are synthesizing three highly distinct sources today that sort of track different altitudes of the housing market.
Yeah, let's go over those.
So we are pulling from a commercial real estate update by CR Daily. Then we have an August 2025 single-family rental market analysis from the financial firm Houlihan Lokey. And finally, a really sobering 2026 gap report from the National Low-Income Housing Coalition, or NLAHC.
Right. And by combining these three, we are going to explore why renting a house in the suburbs is somehow becoming the permanent reality for the middle class. While at the exact same time, the lowest income renters in this country are facing the staggering systemic shortage of 7.2 million affordable homes.
Yeah, it's a massive duality.
Okay, let's unpack this. Why are we suddenly seeing a massive historic boom in single-family rentals? I mean, where is this coming from?
Well, the sheer scale of the shift is probably the best place to start. According to the data from CRE Daily and Houlihan Lokey, the number of single-family homes being used as rentals just hit a 7-year high.
Wow.
Yeah, 14.6 million in 2025. And to understand the mechanism driving this, we really have to look at the raw economic pressure that's been building over, I'd say, the last 2.5 decades.
Since around the year 2000, right?
Exactly. Since 2000, the median U.S. home price has surged by 156%. It climbed from around $165,000 to well over $423,000.
Which is just a wild jump. But the issue is that wages just haven't kept pace with that trajectory at all.
No, not even close. Over that exact same 25-year period, median household income only grew by 99%.
Right.
It moved from roughly $42,000 to just under $84,000. So the purchasing power of the median earner has just been continually eroded by this asset inflation.
Yeah, and then you factor in mortgage rates hovering around, what, 7%?
Yeah, around 7. And the cost of borrowing capital to buy those inflated assets pushes the monthly payment far beyond what a typical family can actually sustain.
It's like being on an escalator that suddenly speeds up, but your wages decided to take the stairs.
That's a great way to put it.
Like you might be climbing, right, you're earning more money than you did 10 years ago, but the destination is just moving away from you at twice the speed.
Exactly. So people are looking at the math and realizing that renting isn't just a temporary stopgap anymore. It is, fundamentally, the only financially viable option to get the space they actually need.
Right, because of where people are in their lives.
Exactly. That demographic pressure is the core engine of this trend. Millennials have overtaken baby boomers as the largest living generation, and they are squarely in their prime family formation years.
So they need additional bedrooms, they want a backyard for the dog, and they're, factoring in good school districts.
Right. But because they are totally priced out of the purchase market by that $50,000 affordability gap we mentioned earlier, the real estate industry is aggressively restructuring itself to meet them where they are.
Which brings us to the rise of build-to-rent communities, or BTRs. Because we aren't just talking about individual houses scattered throughout a subdivision that happen to be leased out by an owner.
No, this is entirely different.
Right. Developers are buying massive tracts of land and building entire residential neighborhoods from the ground up, specifically designed to be rental properties.
And what's fascinating here is how institutional capital is completely pivoting their operational models. Build-to-rent construction now accounts for over 7% of all single-family housing starts in the country.
And historically, that was what, much lower?
Much lower. Historically, that figure sat quietly around 2.3%. The reason developers and investors prefer this new model is purely operational efficiency.
Ah, that makes sense.
Yeah, because managing 100 rental homes scattered across 3 different cities is just a logistical nightmare.
Right, calling different plumbers, different landscapers.
Exactly. But managing a contiguous neighborhood of 100 homes, where every property uses the same HVAC system, the same plumbing fixtures, and shares one maintenance team. That is incredibly profitable.
Okay, I have to push back on the broader narrative here, though, because if we have 14.6 million single-family rentals in the country, and developers are pouring all this money into new rental neighborhoods, it really feeds into this very popular idea that massive Wall Street firms have hoarded all the housing supply.
Right, that's the headline you see everywhere.
Yeah. The common belief is that the middle class can't buy a home because a hedge fund outbid them with some crazy all-cash offer. Does the Houlihan-Lokey data actually support that?
No, it actually actively dismantled that narrative.
Hmm.
It's a highly publicized talking point, sure. But institutional investors actually own less than 5% of the single-family rental stock in the United States.
Wait, less than 5%? That feels completely disproportionate to the amount of blame they receive in the press.
It really is.
So if Wall Street isn't holding the remaining 95% of these 14.6 million rental houses, who is?
The market is incredibly fragmented, actually. It is overwhelmingly dominated by mom-and-pop landlords.
Oh, wow.
Yeah, these are everyday individuals, maybe small partnerships, who own, 1 to 9 properties. But your underlying question is the right one to ask. If property values are at historic highs, why are these individual owners holding onto the houses instead of cashing out and returning that inventory to the purchase market?
Right. So you could argue that it's actually the mom-and-pop landlords hoarding the starter homes, not Wall Street. What is their financial incentive to keep these properties off the market?
It all comes down to the mechanics of debt, specifically something called the lock-in effect.
Okay, break that down for us.
So as of 2025, 62% of all mortgage holders in the U.S. have interest rates secured below 4%.
Wow. Because they bought or refinanced during the pandemic?
Exactly, when rates absolutely bottomed out. And that low-interest debt is practically an asset in itself now. If an owner sells that house, they extinguish that incredibly cheap debt, and any new property they finance is going to be at current rates.
Like the 7% we mentioned.
Right. The math actively punishes them for selling.
And we also have to factor in the generational wealth transfer, or I guess the lack thereof right now, because baby boomers hold a staggering percentage of American real estate.
They do. And the survey data shows that a full 1/3 of boomer homeowners state they will never sell their primary residences.
Never.
Never. So when they decide to downsize or maybe move into assisted living, they don't list the family home for sale. They or their adult children just convert it into a rental property.
Which creates a massive shadow inventory, as the report describes it. It starves the purchase market of supply, which keeps home prices artificially high. But it floods the rental market with single-family options.
Exactly.
So what does this all mean?
Well, it means we have a causal chain reaction. The middle class is essentially trapped in the rental market because the purchase market is locked up by high prices and low interest rate hoarding.
But this middle-class demand doesn't just exist in a vacuum. I mean, if families who make $100,000 a year are forced to rent, they are occupying properties that would otherwise be available to households making $70,000, who then occupy the units meant for those making $50,000. It creates this top-down pressure cooker.
And that brings us perfectly to the 2026 GAP report from the National Low-Income Housing Coalition. Because when we shift our focus from the middle class to the bottom of the economic ladder, we stop talking about market adaptations like build-to-rent communities, and we start talking about severe systemic failure.
Yeah, it gets pretty dark.
The pressure cooker you just described has mathematically crushed the lowest income earners.
Okay, before we get into the actual deficit numbers, let's define the terminology so everyone's on the same page. The report specifically focuses on extremely low-income renters, or ELI households. What is the actual threshold for that designation?
So it is a strict federal metric. An ELI household is defined as living at or below the federal poverty guideline, or earning 30% or less of their area median income, whichever is higher.
So we are talking about the absolute most economically vulnerable demographic in the housing ecosystem.
We are, and there are currently 11 million ELI renter households in the United States.
Wait, 11 million households? That's massive. And what does the supply side look like for them?
It's bleak. Across the entire country, there are only 3.8 million rental homes that are both affordable and available to them.
Oh, man.
Yeah, that leaves an absolute mathematical shortage of 7.2 million homes. To frame it as a ratio, for every 100 extremely low-income renter households, there are only 35 homes that they can actually afford to live in.
That is, I mean, think about it like an economic game of musical chairs. You have 100 people circling 35 chairs. When the music stops, 65 people have nowhere to sit.
Right.
But in the real world housing market, those 65 people don't just vanish into thin air. They still need shelter. So they are forced to grab chairs that are technically way too expensive for them, which pushes them into severe financial distress.
And this is where we see that top-down pressure you mentioned earlier. The NLIHC report highlights a crucial distinction between affordable and available.
Right, because those are two very different things.
Exactly. A unit might technically be priced low enough for an ELI renter, making it affordable, but it isn't available to them because a middle-income renter who couldn't find anything else in this squeezed market has already signed the lease.
Wow.
Because of this dynamic, 66% of extremely low-income renters are forced to live in homes technically meant for higher income brackets.
But if the demand is so overwhelmingly high, like 11 million households needing shelter, why isn't the private market stepping in to build apartments for them? Developers love demand, so why aren't they building to fill this 7.2 million home gap?
That requires looking at the raw mathematics of real estate development. The private market is fundamentally incapable of solving this without intervention.
How so?
Well, if a developer buys a plot of land, pays for the municipal zoning permits, purchases raw materials like steel and lumber, and pays a construction crew, there is a hard baseline cost to building a physical structure.
Sure, materials and labor aren't cheap.
Right. So to pay back the bank loan on those construction costs, the developer might mathematically have to charge at least $1,500 a month in rent just to break even.
But an ELI household might only bring home $1,200 a month total, meaning they can only afford maybe $400 or $500 for rent.
Precisely. The private market literally cannot build an apartment that rents for $500 a month. The cost of materials and labor alone exceeds the revenue. It is a market failure rooted in construction economics.
That makes total sense.
And if we connect this to the bigger picture, the 7.2 million shortage is essentially a conservative estimate.
Wait, really? How so?
Because the survey data relies on physical addresses. It only counts people who are currently housed in a physical structure. It completely misses the nearly 771,000 people experiencing homelessness on any given night.
No, of course.
And it also fails to capture the estimated 3.7 million individuals who are doubled up, sleeping on friends' couches or cramming multiple families into a single apartment because they have absolutely no other viable option.
So that 7.2 million gap only represents the people who have managed to get their names on a lease, even if doing so is completely financially destroying them.
Yes.
Well, here's where it gets really interesting, because when we talk about extremely low-income renters, public perception often defaults to a very specific and I'd say highly inaccurate stereotype about who these people actually are.
Yes, the assumption is often that they simply aren't participating in the workforce.
Right. But the demographic data shatters that assumption completely, doesn't it?
It absolutely does. When we analyze these 11 million households, 34% are actively in the labor force.
Which is a huge chunk.
It is. And of that working group, a significant portion are working 40 hours a week or more. We are talking about full-time employees in low-wage sectors like retail, food service, home health care, who work all month and still cannot earn enough to secure basic shelter.
And what about the remaining 66% who aren't in the labor force? Who are they?
Another 33% of ELI renters are seniors who have aged out of the workforce and just rely on fixed incomes. 18% are individuals living with a disability that prevents them from working.
Okay.
And then the remaining sliver is made up of full-time students or single adult caregivers who are tending to young children or disabled family members.
So the people bearing the absolute brunt of this crisis are the elderly, the disabled, and full-time minimum wage workers.
Exactly.
And we established earlier that many of them are forced into apartments that are mathematically too expensive for them. What does the fallout of that actually look like on a, month-to-month basis?
It creates what the housing industry calls severe cost burden. In housing economics, you are considered cost burdened if you spend more than 30% of your gross income on rent and utilities.
Right, that's the standard rule of thumb.
But you cross into being severely cost burdened if you spend more than 50%. And among extremely low-income renters, a staggering 74% are severely cost burdened.
That's just wild. I mean, if you're listening right now looking at your own paycheck, imagine half of it just vanishing the second it hits your bank account. And remember, we're talking about people at the very bottom of the income ladder.
Exactly.
Like, if you make $10,000 a month and spend half on rent, you still have $5,000 left for groceries and life. But if you make $1,200 a month and $600 goes to rent, Trying to stretch that remaining 600 to cover food, healthcare, transportation, and utilities is an impossible tightrope walk.
It leaves zero margin for life's inevitable friction. A single unexpected medical bill or a blown tire on your car doesn't just mean you have a tight month. It actively triggers an eviction cycle.
Right.
And it is really crucial to analyze how this systemic burden is distributed because the data reveals some incredibly stark racial disparities.
The compounding interest of historical inequity, how did the demographics actually break down in the report?
Black, Latino, and indigenous households are vastly overrepresented in the ELI renter category. For instance, Black households are 3 times more likely than white households to be extremely low-income renters.
3 times more likely.
Yes. And similarly, Native Hawaiian, Pacific Islander, Latino, and indigenous households are more than twice as likely as their white counterparts to fall into this group.
Right.
The NLIHC researchers point out that these metrics are the direct downstream results of decades of systemic barriers, from historical redlining to ongoing disparities in employment and generational wealth transfer.
So if the private market is mathematically incapable of building affordable units and 11 million households are just teetering on the edge of severe cost burden, what is the NLIHC's proposed roadmap? Because it seems like the only lever left to pull involves major policy intervention. And just to be clear to everyone listening, we are just looking at the report's suggestions here. We aren't endorsing any specific political policies.
Right, absolutely. We're just looking at their roadmap. That is exactly their conclusion, that policy intervention is required. The report outlines several necessary federal and local interventions to bridge the gap.
Okay, what's their first proposal?
First, they argue for a massive expansion of deeply targeted rental subsidies, like housing choice vouchers. Currently, because the programs are just so underfunded, 3 out of 4 households that legally qualify for assistance receive absolutely nothing.
Really? They just get nothing?
Nothing. They simply sit on wait lists for years.
Wow. And what about the supply side? Because subsidies help pay the rent, sure, but we still physically lack 7.2 million units.
Right, so the report calls for aggressive federal investments to preserve existing affordable housing before it degrades or just gets redeveloped into luxury units.
Yeah.
Furthermore, they heavily emphasize the need to reform local zoning laws.
Ah, zoning.
Yeah. In massive swaths of the American suburbs, it is technically illegal to build anything other than a single-family home.
Right. You can't build an apartment complex even if you want to.
Exactly. So reforming those laws to allow for duplexes, triplexes, and larger apartment buildings is critical to bringing down the baseline cost of land and development.
So if we pull all the way back and look at the entire board today, from the CRE daily data all the way down to the NLIHC report, we are looking at a deeply fractured housing ecosystem going into 2026.
Highly fractured.
Yeah, for the middle class, the market is finding a new, albeit very expensive, equilibrium. Institutional money is building these highly amenitized rental neighborhoods, and mom-and-pop landlords are holding a shadow inventory of family homes.
Yes. The top half of the market is basically innovating around the high cost of debt. But for the 11 million households at the bottom, the system is fundamentally broken.
Broken beyond repair by the private market, anyway?
Right. They're trapped in a structural deficit of 7.2 million homes. They're handing over half their income just to maintain basic shelter. And the private market offers absolutely no viable exit strategy.
Yeah.
And this raises an important question regarding the long-term macroeconomic health of the country.
It really does. I mean, for generations, the primary engine of wealth generation for the American middle and working class has been homeownership.
Right.
It acts as a forced savings account. It builds equity that can be borrowed against to, start a business or send a kid to college. But if renting a single-family home becomes the permanent reality for a massive segment of the population, and the lowest earners are drained of all their capital just to survive the month, what replaces that engine?
That's the million-dollar question.
Exactly. How does the next generation build any meaningful equity if their largest monthly expense is actively funding a mom-and-pop landlord's retirement portfolio instead of their own?
That is a structural reality that will redefine the economic mobility of the American public for decades to come.
It's definitely something to chew on. Keep that in mind the next time you drive through a suburban neighborhood and see a new family moving into a house with a for rent sign out front. Thank you for joining us on this deep dive. Keep questioning the systems around you, keep looking past the surface-level headlines, and we will see you next time.